Hey, everybody, and welcome back to another episode of Key Factors. I'm your host, Mark Jjones, and today I am joined by two of my seasoned loan officers. I have Matthew Stansbury and Jennifer Jjones. Guys, how y'all doing?
I'm doing good, Mark. Thank you for having me.
Doing good today, thanks.
Awesome. So today we are going to be discussing how rates really work. We're going to be pulling back the curtain and unveiling some of the things that I believe are kept from consumers when they're shopping for their mortgage, that I think we should know as consumers. So as we get into this discussion, we'll be talking about things like credit scores, paying down points, down payment amounts, DTI, price per county, things of that nature. So as we know on our side, there are many factors that go into calculating an interest rate. And most of the time, people don't even know or realize that you can't lock one in until you're actually under contract. And I think that's one of the craziest things that consumers don't really know just yet. So as we jump into this, let's talk about those factors. Let's talk about, first off, in regards to consumers reaching out to you, how often do you get, hey, what's your rate today?
I would say I get that question every so often. The answer that I typically give is it depends. There's a lot of different factors that come into play with interest rate. Number one, usually being the loan program. So each loan program can have a different interest rate, whether it be conventional, FHA, VA, USDA. And then there is also a lot of factors that come into play once you have your credit score.
And I think what you're conveying is consumers are trained to think interest rate. And that is one of the, let's say, selling points of any mortgage company or any mortgage lending institution, which, as we know, it gets the phone to ring. How much of a factor does it actually play into the overall payment of a consumer and their mortgage, you know? So Matt, on your end, how often do you get the question, what's your rate today?
I get it quite frequently. I get, excuse me. I get it quite frequently. I get, consumers coming in, they're like, I have an 800 credit score. And I'm like, well, let's fill out an application, see where things go. And then we can talk about rate and more or less look at what options are available for you. Just because rate isn't the key factor in somebody's monthly payment, it looks good. You get that bragging rights like, oh, I got the lowest interest rate. But did you get the lowest monthly payment overall is what I want my consumers or my borrowers to go, hey, this is more important than this. And the reasons being is, I can have somebody that has a higher interest rate, but I work up a loan scenario going conventional or doing a potential second lien that mimic or give them a better monthly payment overall and long-term save them more money than just having that slight decrease of 1/8 of a point.
Sure. So what types of factors would essentially cause them to not be so focused on the interest rate because you can provide a different solution to their situation? What would be some of those factors?
Well, for example, the down payment amount can come into play. So when we're looking at conventional loans, particularly, once you hit a 20% down payment, the interest rate is actually a little bit higher than if you're at 10% down or 15%.
Wait a minute. So you're saying that if I put more money down, the bank or the investor is going to give me a higher rate?
That is true.
Why is that? Why would you think that would be?
Because at that point, there's a little bit more risk, which is commonly overlooked because you think I'm putting 20% down, there's less risk, I'm very invested in it. But you no longer have that private mortgage insurance, which is a protector to the lender. And so at that point, it becomes a little bit more risk until you have a little bit more invested in the property. Or if you have private mortgage insurance, then it's less risk, which determines a lower interest rate.
Absolutely. No. And I see it in our pricing engine. For those out there that are in the lending world, we actually use a system called Marksman that links together all of the pricing for that day or that minute, that moment. And it does change that often. Others may use Optimal Blue. Some may use a pricing sheet to be able to take away or add to the hits that you get based on credit or DTI or location or program or anything of that nature. But our system essentially does that for us. So when we're plugging this stuff in and we price up a scenario with 20% down only to find that the rate is actually higher, you kind of scratch your head and try to digest that before you give the news to the consumer. But then in dissecting it, it makes perfect sense because there is no mortgage insurance on there. So there's no real protection for the investor other than the fact that there is 20% equity in the home. And if something happened, that they would have that 20% equity to fall back on versus the 20% equity plus mortgage insurance that they have to fall back on. Makes perfect sense. Makes perfect sense. Kind of similar situation to waiving of the escrows.
Right. And that's something I wanted to jump in on. Sure. Since we're at 20%, I've even noticed that you have borrowers that, a little bit more, I guess I would say smarter with their funds in the sense that they want to waive escrows. I've seen interest rates when you waive escrows have 20% down. Your interest rates go up just a little bit when you waive escrows also. Right.
Now, so in talking about waiving escrows, some folks that are listening may be wondering, well, what is escrow? How do I waive escrow? And what are the benefits to waiving my escrow or having an escrow account? So does either of you want to chime in on that?
So whenever it comes to your escrows, whenever I'm explaining it to people, I say it's a small savings that the lender does for you at zero cost, meaning that they are taking all of your funds for your taxes and homeowners insurance in a physical year, saving that money to then pay it at the end of the year. So what are they doing with those funds? They're applying them to a high yield savings, which you could do essentially with a smaller portion, of course, because they have hundreds of consumers that are coming in and doing this escrow that they're making money off of your money.
Right. And I think that's absolutely correct. Now, what are ways that someone listening would be able to waive their escrow? Because not everyone can waive their escrows and manage it on their own. What are ways that could actually happen?
So one of the ways is, of course, putting 20% down on a conventional loan. That isn't an option if you're going FHA. Private mortgage insurance stays on the life of the loan. Your only option would be going through a conventional route with the 20% equity in the home.
Okay. And what about lender paid, borrower upfront paid? We've got a second lien. Putting a second lien on there absolutely helps you do that. And just briefly, placing a second lien on your home as a tool is a great way to not pay mortgage insurance in addition to simulating a 20% down. So that does, in fact, allow you to waive the escrow.
That'd be something to dig deeper into.
Right. And when you select for that, although it may be the best option, you are going to be offered a tiny bit higher rate simply because the investor doesn't have the opportunity to make money with your own funds. Crazy concept, huh?
It's funny how that works.
Yeah, these investors are going to get their money regardless, And I think mortgage is something that is not going to stop in the future because we don't, like other countries, wait until we have enough cash to buy homes. The American dream is going to continue to be financed, right? So that being said, let's talk about credit assumption. So essentially, when you jump in online to go and rate shop, so to speak, you are looking at the rates based on a company's profile, but most people don't tend to scroll enough towards the bottom of the page where it says disclaimer, rate assumption. We are providing you these interest rates based on a scenario of $400,000 loan program, 800 credit score, purchase in Tennessee with 20% down.
So pro tip, read the fine print.
Absolutely. No, absolutely. And it is, I guess, enlightening when we're able to show, and I think I have to thank technology and the advancements, and that's one good thing that came out of COVID, which is the comfort of doing financial advising, things of that nature on a Zoom call with a customer. So it allows you to share and show your screen, giving you the opportunity to explain yourself, not just, hey, this is what it is, please believe me.
Right. Yeah. So one thing that I like to do with my clients is show them what is actually the par rate for that time frame once they go under contract.
So par rate, explain par rate, because there's folks that probably don't know what that is.
So par rate is going to be your base rate, not paying any additional closing cost to be able to get the rate for that day, or actually really for that minute that you're locking it in, because it can change throughout the day. But you're not paying any additional fees for that rate. When you pay points, you're actually buying down your rate, which can provide a lower interest rate. And the amount that you pay for those points can vary each day and also vary throughout the day as well. So you might be able to get a quarter of a point less, half a point less, 1 to 2 points less just by paying an additional fee in points. And the easiest way to calculate that is, let's say for sake of simplicity, you have a $300,000 loan. 1 point is 1% of that. So you'll be able to have the lower interest rate.
Okay. And let's say if someone wanted to do that, because what I'm understanding right now is we have par rates, and anything below par, the consumer has to pay to bring it back up to par. And then after we discuss this, I want to talk about what happens if it is above par. You know, there's got to be extra there. So we'll shed light on that as well. But what would be the determining factor for someone to decide to buy down X rate for Y price? What would be that?
So people want to obviously have the lowest monthly payment, but you also want to look at the long term. So if you're only going to be in the home for, let's say, a year and a half, 2 years, you may not want to invest $3,000 in buying down your rate because you're never going to recover it. But if you're going to live in the home for 15, 20, 30 years, after you recover what you paid down, then you're going to save in your monthly payment from that point forward. So it's not always beneficial to buy down your rate. Sometimes it's a little bit more beneficial to have the higher rate so that you're not losing money in the long term.
Absolutely. So break-even point is what is a key factor that a consumer should consider. And if your lender does not know how to determine or explain to you how the break-even equation works,
Get a new lender.
find a new lender, definitely. And for those listening, in order to determine what your break-even point is, you take the amount of funds that it cost you to essentially buy down that rate. So, for example, if we have a $3,000 for 1 point to buy down the rate, let's say 0.25%, giving you a difference in, we'll call it $20. You take the difference between the payment that you had and the new, and you divide that by the amount that it cost you. So for example, I'm going to pull my phone out here real quick and just hypothetically, which I don't like to do hypotheticals, but for purposes of this, let's say there's a $20 savings for you buying down the rate 0.25% for $3,000. So you take that $3,000 divided by your 20, it will give you 150 months. So 150 months divided by 12 equals 12 years and 6 months. So if your customer was going to stay in the home 12 years and 7 months, they'd win by making that decision of paying down the points. Now, if they were going to if they were going to have a break-even point of 5 years and they're only going to be in there 3 years, which the likelihood of that is very high, 3 to 5 year mark on home purchases and them actually sticking to the property, then they may want to consider not going about it that way.
Yeah,
right?
and I have some clients that I'll talk to them and go over this scenario with them, but they're like high and mighty that they want to put money down towards their loan or what have you. So I'll tell them, like, look, this is what it is. This is your break even. This is how many years you told me versus the money that you won't recoup. Right. Why not take those funds and just apply it towards your straight principal?
Apply it directly towards the principal. And I call that killing the P, killing the principal. And the reason why that is important, and a lot of consumers do not understand this concept, but we'll articulate it now, you're only paying interest on the balance of the mortgage. And I will tell you that the lender or the investor gets their money up front. So when you look at an amortization calendar, an amortization schedule, you will see that most of your actual mortgage payment is going towards interest for the first almost 7-8 years until it flips to the other side. So as you put more funds towards the principal of the property, you're paying less interest overall. Essentially, on an amortization, you're saving years, which in those years, or months, I should say, within those months, that's interest that you would have paid otherwise. That's the concept of it. So that's absolutely a key factor in what someone would be interested in if they wanted to learn more about rates versus just, I want to have the best rate, right? So what else? Let's talk more about rates. What in the world is going on with rates? Are rates going to go up? Are they going to go down? Who knows, right?
Yeah. If we were, I guess, if I could foretell the future, we wouldn't be doing mortgage.
I would have to agree with you 100%. And when customers ask, so what do you think rates are going to do? I tell them flat out, I don't know. I don't know. I can tell you what they're at right now. I can tell you where they've been in the last couple of days, but I will not risk a decision based off of my thoughts on the market. I'm not a market analysis specialist or anything like that. I'm a mortgage professional. And like Matt said, if we knew what rates were going to do, I promise we wouldn't be doing this.
Yeah. And looking at interest rate in a whole, I mean, if you really sat down and thought about it, all of this, credit score, by the down payment amounts, the debt to income ratio, the county, all of this is just risk factors. So the lower your risk in any situation, the better your deal overall will be when it comes to interest rate.
That makes perfect sense. So now I want to transition because we just talked about buying down points. Why? Because you're below par, so we've got to bring it back up to par, and par is only a term that we use on our side, which is the benchmark for the daily rate or the rate of that day for that investor, and what they're paying to the lender for getting that loan. What about over par pricing? What happens there?
With overpar pricing, you actually can get a little bit of a credit toward your purchase. So if it is priced over par and there's an extra $100, $500, $1,000 in play with the interest rate, we can then take that amount and apply it toward your closing costs to help lower your funds for closing.
Okay, so and I've actually had opportunities to use this pretty often in the last, let's say, 6 months because of what's happening in our market, in the sense that homes are not appraising for the prices that they're contracting in many cases. So the buyer is having to bring the difference in cash. So I believe in educating them of how little the interest rate moves depending upon your rate, or how little your payment moves dependent upon your rate. I've had a lot of consumers opt to go with a much higher rate so that they can get more towards closing cost, which then gives them money left in their pocket to pay the it didn't appraise moment. Have you guys had that happen recently?
I haven't had any with mine particularly. We have had low appraisals and we've had to rework items. But thankfully, we haven't had to go that route.
Okay.
Yeah, and I haven't seen it quite like that, but I have used over par pricing for different reasons. One of them is if I'm going on a conventional route, I'll give the option to over par price to pay off mortgage insurance upfront.
Okay, that makes perfect sense. So essentially, in that scenario, you would be eliminating the mortgage insurance upfront by way of the mortgage company, but essentially the buyer paying their mortgage insurance in a different way.
Right.
So you're putting it in their monthly payment and getting rid of it completely. Whereas if it was still in their monthly payment and the lower rate, in some cases, the mortgage insurance would outweigh the increase in rate. That makes sense. Yeah, that makes sense. So I believe they call it lender paid or borrower paid upfront mortgage insurance. And that's something that I believe most lenders are not familiar with. So it's probably not an option that you see given quite often. I mean, for those listening that have gone through the mortgage process, were you even offered a no mortgage insurance option? Something to think about.
And only giving 10% down.
Yeah, absolutely. I mean, you can actually do it as little as 5%. So, I mean, there are opportunities, and I think that is the significance of reviewmymortgage.com, where you can go self-diagnose and research as many loan programs as you can possibly think of and not think of. That way, when you do actually speak to a mortgage professional, you're equipped with the right questions. You're equipped with the right knowledge that you can ask them, why aren't you offering me this program? Do you guys not offer it? Do I need to shop elsewhere? So again, Review My Mortgage is the largest index for mortgage products nationally. So that being said, are you seeing in our market right now that you have buyers that are holding off because they want interest rates to go back down? You seeing any of that?
I haven't seen anybody holding off because of it. I have a few people still shopping for refinances, thinking that rates are still in the ones. And so I just let them know that the bottom line pricing is kind of past. That was in 2020. But I do see that people wanting to buy homes at this point, they're just very excited about getting into a home. So they're still cognizant of what rates are, but they're still moving forward with their home purchases.
Gotcha. That makes sense. How about you?
Yeah, no. I mean, for everybody listening, we're located here in Texas and San Antonio. The, I guess, inventory that is out right now is pretty low. So most of our buyers tend to be excited once they do get an offer accepted because they've been waiting for months and, as far back as half a year to a year. Right. So when it comes to interest rate and, beginning of this year, interest rate was a little bit lower than where it is now. I just informed them and talked them through it. Like, hey, go back 3 years ago. What were interest rates then?
Yeah.
I mean, we're still going through an all-time low of where interest rates are in our market currently. So, I mean, it's just more of educating our borrowers.
Absolutely.
On that.
Now, being that we are on short inventory of properties, you kind of know in your back pocket that it may be a little while before the borrower that you pre-qualified today actually finds a property and gets it under contract. So that being said, do you take more time in explaining some of these things that we've talked about today, like your mortgage insurance, your rates and how they work, things of that nature? I mean, what is your process like, Jen?
Absolutely. So my process is educating them up front as to what type of loan programs they qualify for. And I just touch on the information for rates and how to maneuver through. But once they go into contract, that's when we can really dive deep in because the numbers may look a little bit different. And so until they are actually under contract on a property, we don't know what, if they want to escrow, what the property taxes are going to be, what the homeowner's insurance is going to be. They might find a property that the homeowners insurance is so much lower than we initially calculated that their monthly payment is actually $100 or $200 less than we originally started with. And so they're thrilled no matter what interest rate they end up with. But once they go into contract, then we can look at if the payment isn't quite where they thought it would be. It's not always even just looking at their mortgage. It's also looking at their overall finances. And so sometimes if they have a debt that was taking up $200 a month, then they might be able to pay that off and put down maybe a little bit less in their down payment, and still end up with less in their overall monthly expenses. So when we look at it, we don't just look at this is the lowest interest rate. We try to help our clients see this is the best overall scenario for you as you move forward in life.
No, that makes perfect sense. Absolutely. And it's setting them up for, as I like to say, their next mortgage or their next opportunity. Why? Because everybody wants to believe that the next home that you buy is your forever home. Statistics have you wrong. It's about 3 to 5 years is when a typical consumer, and this is not just a millennial thing, this is just how it's happening at the moment. I don't know if people are realizing the amount of equity that they have and then potential for upsizing, downsizing, paying off debt, different opportunities, starting over, starting a business, so many different things that your mortgage as a driver financially can add to you as a consumer. You know, I've seen many consumers take advantage of cash outs in the last 6 months because interest rates were so low, and they're really borrowing from themselves to go and leverage to either buy investment properties, start that business that they always wanted to, pay off debt to get themselves in a better position, consolidate, those types of things. And the conversation of interest rate honestly comes up every single time, but I address it by explaining and educating, just like you guys have talked about today. So let's see, what else with the rates? I mean, on your side of things, Matt, you're coming in contact with plenty of borrowers, and at times you have folks that are shopping you. Yeah. You will find quite often that you'll have a borrower coming to you from a bank or a FDIC institution, to where they're not licensed, they are registered, and they're offering them a sweet rate. And let's say you, being a mortgage banker, are higher in price. Why is that? What's the facade about that? Why would somebody be okay to pay a little bit higher for your services than the bank?
I would say one of the things is that we provide a lot more value in way of giving options versus just pushing a product onto somebody because it has a low interest rate or holds that value, right? One of the things that we do is provide options to the borrower, give them different scenarios, like you said, to set them up for future homes to come versus the now. In way of, looking at debt, looking at credit, looking at their whole buying power. And that way we can give them possible solutions to overcome certain situations where they then become the first person in their family to actually have rental properties or to move further and buy that $500,000 home by leveraging the current home that they have, just giving them different options versus your normal bank that's just going to take it, look at it, and then pass it to the next person.
And I guess my question is what justifies their rate or your rate that is a tiny bit higher, which I understand you're able to give the advice, things of that nature. But if someone is not really concerned with your advice, let's say I've bought 3 homes, I'm just looking for the best rate. What's another reason why your little bit higher rate would still be more attractive in a market like today? How about getting their offer accepted with a bank's approval letter? Y'all seen a lot of that? Have y'all seen that? I have. I know I personally have. So being that Kristen and I flip properties, we're We just had one go live last Friday. We've got 15 offers on it and all strong offers, but we weeded through them. And one of the factors was if it's with a bank, they don't have a chance. Like, we're not accepting it. Why? Because number one, we can't get a hold of the lender or the loan officer working on it, 9 to 5, maybe. We know that loan officer really hasn't done their diligence. They've just collected documents, locked in a rate, and sent it over to their processing team that is a huge black hole of multiple different layers, probably in some other state, ran by someone else that they have zero control over.
Now you saying that made me think of it, and I'm just like, okay, whenever I do communicate with the borrower, I just let them know, like, what's your time frame look like for closing? And I let them answer, and they're like, typically they say, I want to close as fast as possible, Matt, 30 days. I'm like, okay, so you're giving me a bank from, ABC Bank. And it typically takes them about 60. And if you're here in San Antonio, appraisals are 4, 5, 6 weeks out. So good luck on closing that in time.
Right.
Whereas with us, your offer will be accepted if it's viewed, because we don't just give out pre-qualifications. We give out pre-approval letters, meaning we've already done our due diligence. We've looked over documentation, and you're fully approved based off everything that you've given us, versus, hey, we looked at your credit and it's great.
And I believe that is a key factor that you mentioned, is you gather the documents up front before you give out an approval letter, right? Why do you guys do that? I know why.
Yeah, well, I feel like it's become a huge part of the process that we do, kind of like making things streamlined. One, it makes the loan process go a little bit quicker when we have everything up front, but also we're doing our due diligence and making sure that this borrower is actually pre-qualified or pre-approved, should I say. That way we don't run into any hurdles when it comes time that the contract is accepted.
So you're saying that your borrowers are able to shop with confidence, knowing that if they put an offer in on a property, get it accepted, they're not going to hear back from you 2 weeks later saying, hey, you don't qualify.
Right.
Kind of like other banks may do, because you can jump in, and consumers out there that are shopping, you can jump into many websites to get an approval letter by putting in your information, letting them pull your credit, putting how much you make, all that good stuff. And I've seen them time and time again. You have an approval letter that you can actually use to put in offers with, but no one has seen your documents. So that, let's say $5,000 a month that you put in for your application really is only $3,000 a month, because you now work commission, and were regular W-2 hourly the previous year. Those are factors that I think consumers don't even think about when they're going through this process, because they're uneducated or unfamiliar with what it is that we do on our side.
And thinking about that, I actually had a realtor reach out to me on a borrower that we're working together on this past weekend. He sent me a screenshot and said, hey, Matt, he's like, man, I'm glad that we chose to go with you, because check this out. And he shoots me over this screenshot of a message from a listing agent. And it said at the bottom fine print of this realtor's needs list from offers coming in was needs to be a pre-approval letter.
Right.
Not pre-qualification.
Right.
And I guess everybody that submitted, he said there was 6 other offers, and that they accepted ours because it was the only one listed as a pre-approval.
Right. There are still plenty of consumers out there that are putting in offers with what I call a generic pre-qualification. It takes all the personal touch out of it. It turns it into just another number. Whereas our approvals here at our branch, you can take to the bank. That's kind of how I articulate it to realtors when I first meet them, or when listing agents reach out to see if our borrower is strong. And on the actual approval letter, it invites them to give us a call. We're here, we're real people. Let's find out if you've got any questions, or if your sellers have any questions, so that they feel comfortable and confident to move forward with our buyer. Go ahead.
Yeah. One thing that I do for my clients specifically is when I know they're submitting an offer on a home, I call the list agent and let them know that I have all the documents for the buyer, so that they feel confident about accepting those offers. And I receive a great response in accepted offers due to that. And I don't believe that your bank loan officer would put forth that type of effort. So that is definitely a value that you get from us as loan officers.
Absolutely. Let's say you submit the offer on a Friday at 6 p.m. Good luck hearing from anybody from that said bank until Monday. Maybe, So I think those are great factors. Do you guys have anything else you want to add to this? How you feeling? We're just rapping about rates. The rate rap. All right, guys. Well, we may bring this back to have a little bit further in-depth conversation with scenarios, things of that nature later on down the road. But I do want to allow both of these folks, my loan officers, have an opportunity to give you any kind of advice from a lender to consumer situation. Matt, is there any advice you would give to a consumer that is, let's say, rate shopping, home shopping, something along those lines regarding rates?
If you're shopping, good for you. I always tell my borrowers, if you want to shop, I actually tell them to go ahead and do so. Make sure you're getting a good deal. I would cross-reference it with other loan officers or other brokers, what have you, just to make sure you're getting the best option for your scenario.
Okay. How about you, Jen?
Yes, I agree with Matt. I definitely encourage my buyers to shop around, but ultimately it does come down to customer service. Are you going to get the very bottom line lowest rate and have the worst experience that you never want to buy a home again? Or are you going to say, you know what? This is still a very competitive rate, and I want to have a pleasant experience, and I want this to also help me as I buy my second home, third home, investment home, and I can continue to work with the same loan officer to better my future.
Absolutely. No, that's great advice. So at the end of these episodes, I want to make sure that I point out the key factors in the episode. First key factor that stands out to me is you cannot lock an interest rate in until you're actually under contract. The reason for that is the lender is actually reserving X amount of funds based on your program that you're going through from the investor, and those funds are tied up for a certain period of time, whether it be 15, 30, 45, 60, 90 days as far as the time frame. And that is called your lock period. The second key factor is what really matters to you as the buyer. Be honest with your lender. Obviously, if it's not us or somebody outside of Texas, be honest with your lender. If you're coming at them with rate, but really the thing that matters is the payment, then let them know so that they can provide you with different options to get you to where you're at versus trying to figure out how to lower the rate. And in some cases, that's just not possible given your criteria, whether it's credit score, county, purchase price, amount that you're putting down our program.
Transparency is key, guys.
Absolutely. I would agree 100%. And then finally, last key factor is work with a local expert. I know online lenders can be great, but in your territory, in your area, there is a local expert that has a team built that works with great products, that has the time to spend with you to explain the process. In addition to when you submit that offer, they're known within the real estate community and you have something to stand on. That is super valuable, especially in a market like today's. So that being said, thanks for joining us today on Key Factors. This is Mark Jjones, your host, and we'll see you on the next one.